The profit and loss statement, also called P&L or income statement, measures the capacity to generate profits. I prefer to use the word P&L, profit and losses, because I like to be reminded that losses are a possibility. In order to be profitable, simply put, income must be greater than expenses. That was exactly the type of analysis I used to perform, but we will explore later why this analysis is limiting. Nonetheless, the P&L provides a fantastic starting point for financial analysis. Much of the existing confusion in terms of profits rises from the two accepted formats of the P&L statement, single-step and multi-step. The single-step version is simpler. I prefer the two-step version of the P&L, as it considers both revenues and expenses that are directly related to a production and those that are not. For example, from an income perspective, the sales line typically indicates what an organization offers to sell, which creates an idea of who the clients are. Most likely, sales are the result of a combination of products and services, not just one or the other. Gross margin, also called gross profit, is the result of measuring profits only on the basis of direct costs. In the case of service industries, those costs are mostly related to time. And in many small firms, time is not accounted for, especially the founder. We calculate operating profit by deducting cost, direct or not, from the sales or income of any organization. Finally, net income includes tax payments, as it is the same in both formats. Typically, non-operational income includes interest from bank accounts and so forth. However, there are many hidden sources of non-operating income. Some byproducts that can be considered garbage might have a market value. Paper can be sold and recycled, databases can be rented, even natural gas can be injected back into a subterranean field. And solar power can feed electric networks and so forth. These non-operating sales can generate confusion about the mission of the company. But I've seen many cases where this perspective has allowed companies to turn themselves around after encountering difficulties, and have even shifted completely to a new offering, reshaping the former strategy. This is called pivoting. Go to your class materials for further details and other examples.